Hello, traders. Welcome to our channel. Today, we will learn how to create a personalized trading strategy step by step. If you're new to the channel, don't forget to subscribe and hit the bell icon to receive all notifications. Creating a personalized trading strategy is essential for achieving long-term success in the market. In this video, we will cover the key components for developing your own strategy, including risk management, market analysis, and setting trading goals. Let's get started. First, let's talk about risk management. Risk management is crucial to protect your capital and minimize losses. A good practice is to never risk more than 1% of your capital on a single trade. This means that if you have a capital of $10,000, you shouldn't risk more than $100 to $200 per trade. This approach helps ensure that a single bad trade won't significantly harm your portfolio. Another important tip is to always use stop-loss orders. A stop-loss helps limit your losses if the market moves against you. Set your stop-loss based on the asset's volatility and your risk tolerance. For instance, if you're trading a highly volatile stock, you might want to set a wider stop-loss to avoid being stopped out by normal market fluctuations. Conversely, for a less volatile stock, a tighter stop-loss may be appropriate. In addition to stop-loss, also consider using take-profit orders to ensure you realize profits at predetermined levels. Take-profit orders can help you lock in gains before the market reverses. This is particularly useful in volatile markets where prices can change rapidly. Diversifying your portfolio is another important aspect of risk management. Don't put all your capital into a single asset or market. Spread your investments across different assets, sectors, and geographic regions. This can help reduce the impact of poor performance in a single investment. Diversification can include a mix of stocks, bonds, commodities, and even different trading strategies. For example, you might allocate a portion of your portfolio to long-term investments in stable blue-chip stocks, while dedicating another portion to short-term trades in more volatile assets. This approach can balance potential returns with risk management. Now, let's move on to market analysis. There are two main approaches: technical analysis and fundamental analysis. Technical analysis involves studying charts and price patterns to predict future movements. Technical indicators like moving averages, RSI, and MACD are useful tools for identifying trading opportunities. These indicators can help you identify trends, support and resistance levels, and potential entry and exit points. For instance, moving averages can help smooth out price data to identify the direction of the trend. A simple moving average SMA is calculated by averaging a set number of past closing prices, while an exponential moving average EMA gives more weight to recent prices, making it more responsive to new information. Traders often look for crossovers between short-term and long-term moving averages to signal potential trend changes. The Relative Strength Index, or RSI, is another popular indicator that measures the speed and change of price movements. It ranges from 0 to 100 and is typically used to identify overbought or oversold conditions in a market. An RSI above 70 may indicate that an asset is overbought, while an RSI below 30 may suggest that it is oversold. MACD, or Moving Average Convergence Divergence, is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period EMA from the 12-period EMA, a 9-day EMA of the MACD. Called the signal line, is then plotted on top of the MACD line, which can function as a trigger for buying. On the other hand, fundamental analysis focuses on the economic and financial factors that influence an asset's value. This includes analyzing earnings reports, economic news, and global events. For example, a company's quarterly earnings report can provide insights into its financial health and future prospects. Key metrics to look at include revenue growth, profit margins, and earnings per share EPS. Understanding the macroeconomic context and the fundamentals of a company or sector can provide valuable insights into the long-term potential of an investment. For instance, if you are investing in the technology sector, it is important to consider trends such as advancements in artificial intelligence, cloud computing, and cybersecurity. Combine these two approaches to get a more complete view of the market. For example, you can use fundamental analysis to identify undervalued assets and technical analysis to determine the ideal timing for entering or exiting a trade. This integrated approach can increase your chances of success. Additionally, it's essential to stay updated with the latest market news and developments. Subscribing to financial news platforms, following influential market analysts on social media, and joining trading forums and help you stay informed and make better trading decisions. Setting trading goals is another crucial step. Your goals should be specific, measurable, achievable, relevant, and time-bound. Smart. For example, a goal could be to increase your capital by 10% in the next 3 months. Another goal could be to reduce your losses to less than 5% per month. Having clear goals helps you stay focused and measure your progress over time. Moreover, it's important to tailor your goals to your personal circumstances and risk tolerance. For instance, if you are a full-time trader, your goals might be more aggressive compared to someone who trades part-time. Regularly reviewing and adjusting your goals based on performance and changes in market conditions ensures that your goals remain relevant and achievable. To help you create and test your strategy, we will provide some useful templates and tools. Use spreadsheets to document your trades, including entries, exits, stop loss, and take profit. This will help you analyze your results and adjust your strategy as needed. Keeping a trading journal can also be extremely helpful for reflecting on your decisions and improving your approach over time. A trading journal should include details about each trade, such as the rationale behind the trade, the entry and exit points, the size of the position, and the outcome. Over time, this journal can provide valuable insights into your trading patterns, strengths, and areas for improvement. Another important tool is backtesting. Backtesting involves testing your strategy using historical data to see how it would have performed in the past. There are several trading platforms that offer built-in backtesting features. When backtesting, pay attention to the robustness and consistency of your strategy under different market conditions. This can help identify potential weaknesses and adjust your approach before risking real money. For example, You can backtest a strategy based on moving average crossovers using historical price data. By analyzing the results, you can determine the strategy's profitability and identify any adjustments needed to improve its performance. In addition to backtesting, consider doing paper trading, which is the practice of simulating trades in real time without risking real money. This can provide practical experience and help build confidence in your strategy before putting it into action in the real market. Many trading platforms offer paper trading accounts where you can practice your strategies in a risk-free environment. Furthermore, consider joining trading communities or mentorship programs. Engaging with other traders can provide valuable insights, feedback, and support as you develop and refine your strategy. Learning from the experiences and mistakes of others can accelerate your growth and help you avoid common pitfalls. So, to recap, a personalized trading strategy should include effective risk management, robust market analysis, and well-defined trading goals. Use the tools and templates we provided to create and test your strategy. Moreover, remember that trading is a continuous journey of learning and adaptation. The market is constantly changing, and it's important to keep educating yourself, adjusting your strategy, and learning from your experiences. Attend webinars, read trading books, and consider taking courses to deepen your knowledge and stay ahead of market trends. If you enjoyed this video, please give it a like and share it with other traders. And if you have any questions or suggestions, leave them in the comments below. We love hearing from you and are always here to help. Thank you for watching, and until next time, happy trading.